Good morning. My name is Leah Kratz, and I'm speaking to you from Harrisonburg, Virginia, and I'm also one of the co-authors of your financial accounting textbook. In this video, we're going to begin our coverage of Chapter 12, which completes the conversation of assets. So far in this textbook, we've covered things such as cash, accounts receivable, inventory, property, plant, and equipment such as land, buildings, and equipment, and we've even talked about intangibles. But this conversation on investments is very interesting and much different than our other conversations. The reason is because with investments, depending on the intention of the investor, the level of the investment, and the type of investment, there are many different ways at which we account for investments. This is unlike other assets where we had one, maybe two options to choose from for recording the assets. So the first type of investment that we want to look at today are equity investments. Equity investments are when an organization acquires the shares of another organization, essentially acquiring part ownership. Now, companies like to invest in equity shares because they hope that the value of those shares will increase over time and then they can sell them for a gain. Additionally, they can also earn a return through dividends. Now, when you look at an organization's balance sheet and you see that they have equity investments, one thing to note is that those balances are being reported at their fair value. This is very different than other assets we've seen in the past. Those assets that we've looked at in previous chapters are reported at their historical cost, but equity investments are different. They're reported at fair value. So the first question you may have is, why do we have a difference in rules? Why have we changed how we report assets? Well, with equity investments, there's something very different, and that is those assets are sold on a market such as the NASDAQ or the New York Stock Exchange or some other open market. And we can identify at any point in time what the value of those stocks are, and we have the ability to sell them whenever we want to. There's a ready market for them. That's very unlike other assets. Other assets we may not know exactly what the going rate is for those assets, or we might not have a buyer for those at any point in time. It may take time to find someone who is interested in buying that piece of equipment. But equity investments, there's always someone willing to buy them, and we know the value of them. So we go ahead and report those at fair value when we create the balance sheet. Now, the next question you may have is about the change in value. When the asset changes value, when the price increases, we go ahead and raise the value of the investment reported on the balance sheet. And if the price would go down, we reduce the value of that investment. Any changes in value are reported as a gain or a loss on the income statement. So if the value of the investment increases, the value reported on the balance sheet increases, with that change or difference being reported as net income. Consequently, if the value goes down, we reduce the value of the investment, and that loss is reported in net income. The next question you may have would be about the receipt of dividends. When the organization we've invested in pays a dividend, that cash comes in and we report that as revenue, which will also increase net income. So there's actually, again, two ways for net income to be affected with equity securities, with the increase in fair value as well as the receipt of dividends. The last thing we should mention about equity investments at this point is what happens when you sell that equity investment. Again, as you know, we've been changing the value over time to the fair value of the investment. When we sell the investment, we'll record the proceeds that we receive and we'll remove the investment from the books, but only the change that happened in the current period to the value of that investment will be reported as a gain or a loss in the current period's net income. That's because all of those prior changes in prior periods have already been recorded in net income. So only the value changes in the current period are recorded in net income in the year of the sale. The next group of investments I want to talk about are debt securities. This is where a company will invest any excess funds they don't immediately need in debt instruments of another organization. When they do this, they're not actually acquiring any ownership shares, but rather they're investing the money with the expectation that it will be repaid with interest. Now, how we account for debt investments is very much determined by our intentions. Do we intend to keep these investments for a long time, or do we intend to sell them rather quickly? We'll explore each of these options. Our first group of debt securities that I want to explore now with you are trading securities. These are debt instruments that a company has invested in that they do not intend to keep for a very long period of time. They intend to sell them rather quickly and hopefully at a gain. When an organization invests in trading debt securities, the accounting treatment is rather similar to equity investments. Those debt investments that are classified as trading will be recorded at their fair value, similar to we saw with equity investments. When there is a change in value, any change that's reported gets recorded as a gain or a loss in net income. So if the value of that debt instrument increases, we increase that value on the balance sheet with those changes reported in net income as a gain. Consequently, if the value goes down, we reduce the value reported on the balance sheet for that investment, and the difference is reported as a loss in the income statement. So what happens when interest payments are received? Well, as you know, we have foregone the opportunity to have dividends because these are not equity investments, but in return we do receive interest. That interest is reported as revenue and would increase net income in the period that it's received. And lastly, when you sell a debt investment that's classified as a trading security, you're going to report any changes in value in the current period as a gain or loss on net income. So as you can see, the reporting is very similar to what we saw for equity investments. These are debt securities that are classified as trading because we expect to sell them in the near future. The next group of debt securities that I'd like to talk about are what we classify as available for sale securities. These investments are acquired with the intention to hold for some undetermined period of time. It could be months, could be years. All we know is that at some point in the future they intend to sell them, but we have no determined time frame. It's not probably going to be in the near future. That's not our intention. So therefore we classify these as available for sale. One thing to note when you see available for sale debt securities reported on a balance sheet, you should know that these are reported at fair value, similar to the trading debt securities. When the value of those investments increases, we increase the price reported on the balance sheet. And when the fair value goes down, we reduce that value reported on the balance sheet. But there's one big difference between available for sale securities and trading securities, and that is what happens with the gain or the loss. Because the intention of these investments are to sell them at some undetermined point in the future, we know that these values can change quite a lot over the next period of time. Could be years again until we sell them. And the value could change quite a bit. So it's premature to put those gains and losses in net income. For that reason, those gains and losses are reported in stockholders' equity in an area we call accumulated other comprehensive income. That's a very big difference from trading investments, where we reported those changes as a gain or a loss in net income. Again, we report available for sale securities at fair value, but because the time frame at which we intend to sell them is unknown and could be too far in the future, it's premature to put that gain or loss in net income, so we place it in stockholders' equity and accumulated other comprehensive income. Now again, we will receive interest on these debt securities that are classified as available for sale, and when we do, that would be revenue and it would be reported in net income. Now the last thing you should know about available for sale securities is what happens when we sell them. Again, if we sell those instruments, we'll record the proceeds and we'll remove the value of the assets from the books. But because the changes in value have not actually been reported in net income, we will go ahead and report the difference between the purchase value, or the value we paid to acquire the investment, and the proceeds we received from it. We will record that difference as a gain or a loss in net income at that time, at the point of sale. So again, for available for sale securities, the original purchase price and the difference between that and the proceeds for what we sold it for will be reported as a gain or loss in net income in that period. And that is because none of those other prior adjustments to fair value have actually made it into net income. The next group of investments I want to talk to you about goes back to equity investments. But in this situation, we're talking about an investment that's sizable enough that you can actually apply significant influence over the company you've invested in. Now, in the United States, we consider that level of investment somewhere between 20 to 50% ownership of that company. When you have that level of ownership, you have the ability to do things that will significantly influence the company you've invested in. For example, maybe you can put representatives on the board of directors. Now that 20 to 50% rule is not hard and fast. It is possible to have a level of investment that's less than 20%, but you still are able to apply significant influence. Or maybe you have an investment that's slightly above 20% and you don't have the ability to apply significant influence. These are just guidelines, so there has to be a level of analysis done to determine if you do have significant influence or not. But if it is determined that you have significant influence, you apply the equity method of accounting. So your next question is probably wondering exactly how the equity method works. Remember, we're talking about investments in securities of another organization, but to such a significant level that you can apply significant influence over that organization. Let's take an example where you've acquired 30% of the stock of another organization, well within our limits of applying significant influence. If that company you've invested in earns $100,000 in net income, when that happens, you're going to reflect a similar increase in your own investment and report income for that. So what happens to the company you're invested in happens to you. In the case of that company reporting $100,000, you would report an income of $30,000 or 30% of that income. The other thing to consider is what happens when the company you've invested in so heavily pays dividends. In the past, those dividends are reported as revenue and increases net income. But this becomes a problem because you've already reported income when the company you've invested in reported the income. You wouldn't want to double count the income. So let's think about what dividends actually are. They are a distribution of wealth and they actually reduce the overall size of the organization. So if the company you're invested in pays dividends, that reduces that organization. Consequently, you would also reduce your investment by a corresponding amount. If the company you've invested in pays a $10,000 dividend and you've invested 30% in that company, you would actually reduce your investment account 30% or $3,000. That's very different. And under the equity method, we don't actually pay any attention to fair value at all. So the thing to remember is when something happens to the organization you're invested in under the equity method, you're going to reflect something similar on your own books. Now, the last method for accounting for investments that I want to talk to you about today is when you have control of another organization. You have invested so heavily that you now have control of the other organization. And in the United States, we consider that at 51% of the stock of another organization. Now, when a control has been acquired, we say that there is now a business combination, and the financial statements of the two separate organizations have to be consolidated into one set of financial statements for reporting purposes. How is this accomplished? At the point the acquisition occurs, the assets and the liabilities of the subsidiary being acquired are brought up to fair value, and those fair values are then added to the assets and liabilities balances of the parent organization that acquired them. So again, at the point of acquisition, the subsidiary's assets and liabilities are brought to fair value, and those values are added to the assets and liabilities of the parent, and the combined balances are what are reported on the consolidated financial statements. Let's also take a little closer look at some of the other things you're going to see on consolidated financial statements. As you recall, we just mentioned that the assets and liabilities for both the parent and the subsidiary are combined. The parent's assets and liabilities are reported still at book value, but they're added to the fair value of the assets and liabilities of the subsidiary at the point the acquisition occurred. Now, you also recall from previous chapters, we talked about goodwill in our intangible section. Let's remember what goodwill is and bring that up again. Goodwill is an intangible asset that we report which is acquired through the acquisition of another organization. And here we're talking about consolidation. So this is where goodwill comes in. Oftentimes, when acquiring another company, we pay more than the book value of that company for things that can't necessarily be measured and reported on the balance sheet. Things like a good reputation in the community or a loyal customer base. Those things have value, but we can't put those on the books as an asset. So we're willing to pay more for an organization if we know they exist. Because the value we've reported and paid is more than the book value, that difference is recorded as goodwill. So when you look at consolidated financial statements, again, you're going to see the consolidated assets and liabilities, but you'll also see goodwill reported, and that's how it comes into being. The last thing we want to mention is revenue and expenses on a consolidated financial statement. The revenue and expenses are reported only for the subsidiary after the point of consolidation or an acquisition. Any revenue that the subsidiary earned or any expenses that the subsidiary incurred prior to the acquisition would not be included. That would be reported on their own separate financial statements prior to consolidation. But any revenue that is earned after the point of acquisition and any expenses incurred after the point of acquisition would all be consolidated with the revenue and expenses of the parent organization. So now you've seen we have many different ways of reporting investments. And again, these methods are determined by the type of investment, the level of investment, and our intentions with those investments. I hope this video helps you understand some of the things you're going to be reading and exploring in the chapter. I hope this gets you as excited as I am. I hope you read the chapter. I hope you learn a lot.